Morning. So as Hugh said, you've all read this, you know it backwards, and I'll be doing a test in the lobby afterwards to see who can quote different sections back at me. So I'm not going to go into the details of what is in the action plan. You've had the opportunity to see it. You're probably working out your positions on the different aspects of it. So I'll just maybe focus here on a few messages and a few impressions we're getting played back to us as we start our discussions with different institutions, stakeholders on this, and see if that kind of gels with you or resonates with you. I think what we're hearing first and foremost is extremely encouraging, that there is a very positive impression about the menu that we have proposed, that people see it as ambitious in its breadth and its scope. 33 actions, so hence the analogy maybe to financial services action plan, etc. But I think the scope is necessary, as given the policy challenges are so diverse, so multiple. We felt we had to go after a number of issues that were raised in the consultation process. It's also, I think, innovative in terms of that we, probably contrary to what we've tended to do in the past as my part of the Commission, where we've kind of reached for the legislative stick as pretty readily, we tried to be more innovative in the approach and the toolbox that we use here. So we have a range of things that we're trying to develop using FC fund money, trying to build mechanisms for information dissemination about alternative finance to SMEs. So looking beyond legislation and trying to do things that maybe my Directorate General has not been that engaged with in the past. So a more project-driven approach. Let's see how we get on with that. So we're ambitious, at the same time, as Commissioner Hill likes to say, we're pragmatic in building gradually. On a number of points, it's clear to anybody on reading the text that we weren't confident as regards kind of nailing our colours to the mast on the right approach to take to a particular issue, for example, insolvency or securities ownership. We feel, or personal pensions is another example, we need to build a case, we need to progress, explore, and really get the confidence that we have the right solutions that we're going to put forward. So I think there's a lot of building our case before we're going to commit to action. I think that pragmatism, is just necessary. It's also, I think, born out of a realization that maybe now is not the time for big visions either. We just need to deal with policy challenges as they present themselves in a common sense way. So we are hearing this strong support about the diagnosis that we're proposing. We heard that in the Parliament, in the Econ Committee, from most of the MEPs who were speaking there. Most of the groups have rallied behind this progress. We heard it from member states as they prepare for ECOFIN discussions on this topic in November. So I think there are shades and there are nuances, but globally people get it. The diagnosis that we're posing, I think, is different from what we've done in the past, maybe in financial services regulation, where so this is not sort of old wine in new bottles. This is a focusing back of finance maybe on what we hope it should be about, which is channeling resources to the relevant parts of the productive economy. So maybe areas where maybe finance can be accused of becoming sort of very introverted and focused on risk transfer between financial institutions and building up that risk management internally. And our policy framework, I think, reflected that. A lot of the work we've done has been on infrastructure or risk transfer mechanisms or derivatives markets or whatever. What we try to do with CMU is break out of that and go back to kind of just connecting available funds to SMEs or infrastructures And I think that's really what is driving the whole project. And I think hopefully that will deliver. It will break down the debt dependency culture, maybe bring some more equity into our economy, make our economy more resilient faced with shocks, and create some loss absorption capacity in the system. So I think people see that. There is some skepticism about are the economic conditions around us at the moment the right ones? Is this the right climate? Credit is cheap, it's available. How are you going to sell market-based finance under these conditions when people can just, most member states increasingly go back to the bank, even in countries where bank credit was difficult. Things are starting, thankfully, to loosen up. But we just don't want to find ourselves in that situation again where we have this pro-cyclical contraction in debt finance and suddenly the whole economy goes belly up. I think this CMU is about creating a market-based financing safety net in our system to avoid that. We need to get away from a situation where 75% of the external finance of SMEs is bank credit, and maybe just get a bit more balance into the system. In terms of the challenges ahead of us, clearly my challenge and that of my colleagues is about delivering now on the promises and the implementation of this kind of menu of new actions. We started, I think, with a bang, we hope, at least in terms of the securitization proposals. The prospectus directive will come quickly. The delegated act on infrastructure LTIF for Solvency II. I think we're trying to create a sense of momentum. We need to keep that through 2016 and keep member states and finance ministers convinced that this is worth putting in political capital in and supporting. So that's a bit the approach we've taken with that very large amount of material that we published on the 30th of September, which you've all read, of course. I think maybe just a couple of words on a couple of points. Maybe on substance, I'll just mention three, and then I'll conclude. I think we have placed a lot of emphasis on creating new funding for productive investment, but we're also about giving new opportunities for institutional investors and retail investors. And I think that's going to be mobilizing that capital and convincing people to come back into the market is going to be a challenge, particularly in an environment where equity markets are maybe more febrile than they have been. Bond markets are nobody's necessarily sure where we are in the cycle there, but it's so how do we get institutional investors and retail investors to stay interested in capital market financing? I think with institutional investors it's more straightforward. We're creating access to new forms of exposure in infrastructure, and then later on, hopefully, private debt, private equity, allow them to get more return on the basis that these asset classes can give them a better profile, yield return profile. For retail investors, it's more challenging, and I think the asset management industry will remain critical to bringing in the money, the retail money. The underlying asset classes, even equity and bonds, can deliver. They have delivered over the last 15 years. Looking at the better finance analysis, they've been, an investment of a portfolio in bond and equity, 50-50 split, would have yielded a 35% inflation-proof return. The real investor, or the retail investor, hasn't been getting that, unfortunately. There's kind of too much taken out in fees and cost by the industry, and under these circumstances, we can talk until we're blue in the face about getting retail money back into the capital markets, but it's not going to happen under those conditions. So we need to look at the distribution system, the intermediation system, and delivery of return to the retail investor. One of the other ways we're trying to approach this is the long discussed European personal pension product, a third pillar product. So staying far away from Pillar 1 and even Pillar 2. This is really a personal choice to invest money through these instruments. How do we build that market? I think in the action plan we indicate our willingness to kind of pick this up and look at it and try to determine the conditions under which that market could be helped to progress. And that's not going to be an easy thing to do. We have to build the supply, the demand, the wrapper, the administration, the distribution. We need to think our way through all of this. But I think there is an opportunity there. It's not about forcing anybody to do anything. It's about maybe exploring the opportunity for a product that can be sold more generally. Supervisory centralization, coordination, just maybe a couple of words on that. Our approach in the paper is decidedly pragmatic. I think that reflects the view, the consensus that we heard through the consultation process. We don't think institution building in the area of capital markets was the right solution at the moment. We think ESMA and the network of national authorities have more to give and have the powers that are necessary at this stage. We'll investigate in our white paper on the ESAs next year, just revisit the whole situation, but we think globally it's a question of using the powers at their disposal. The challenges, as I said, are so diverse and multiple that there's no putting Mr. Europe in charge isn't necessarily the right answer to any particular problem. There may be risk transmission challenges that emerge over time where we have to take a different view on specific aspects, but I think, again, we want to take that on a case-by-case pragmatic basis. Final thought I would like to raise with you is small member states who have maybe not been with underdeveloped capital markets, who wonder maybe what's in this for them. I think a lot is in it for them, and hopefully they're the ones who will be the greatest beneficiaries of an integrated capital market, in the sense that capital can flow from where it is abundant and underperforming into economies where there is a developing business community which does not have access to venture capital. 90% of our venture capital is invested in 8 member states. That means a large part of Europe is a VC desert. Same with angel investing, etc. So we're trying to push these channels so that money can access these economies more carefully. That means building an ecosystem and an infrastructure to help the institutional investors in those countries understand the investment. They don't have lots of money. The issuers and the capital raisers aren't looking for lots of money, so the due diligence costs may be disproportionate. We have to try and break down these cost barriers. And I think that's something we would like to explore with our colleagues in the new structural reform support service to try to see how we can help these member states to become the real beneficiaries of this capital markets union. So I'll conclude there by just saying Hugh was absolutely right. This is not going to happen quickly. It's a structural transformation in our economy we're trying to encourage here. Building new funding channels, building new markets, building new ecosystems it requires a market response. We're giving a signal that we want to go in this way, and the markets will hopefully follow, but it won't happen immediately. We're going to have to be patient. We're going to have to continue to invest in this, and we're going to have to revisit our agenda from time to time to make sure that we're asking the right questions and doing the right things. We have a 2017 review, so you can tell us we'll be constantly in discussion, I hope, during the life of this project. But I think that review is an opportunity really to take stock and see if we're making progress in the right direction, and if we need to revisit the prescription. So that's it for me. Happy to answer questions in a few minutes.